The International Monetary Fund downgraded its outlook for the coronavirus-ravaged world economy, projecting a significant deeper recession than slower recovery than it anticipated just few weeks ago. The fund said last week it's now expected global gross domestic product to shrink 4.9% this year, more than the 3% predicted in April. For 2021, the fund forecast growth of 5.4%. It's down from 5.8%, having already warned of a biggest slump since the Great Depression. The IMF said it increased pessimism reflected scaring from a larger than anticipated supply shock during the earlier lockdown. In addition to the continued hits to demand from social distancing and other safety measures, for nations struggling to control the virus spread, a longer lockdown also will take a toll on growth. The projections assumes that countries with a declining infection rate don't need to reinstate the strict lockdown from the first half of the year and are able to rely on alternative methods such as increased testing, contact tracing, and isolation to contain transmission. One bright spot has been financial conditions, which have eased in advanced economies and to a lesser extent in emerging markets. Announced financial measures amounting to about 11 trillion US dollars globally, up from 8 trillion US dollars estimated in April, have helped cushion the blow to workers and businesses. Swift and innovative interactions by central banks have limited the rise in borrowing cost, and portfolio flows into emerging markets have recovered from record withdrawals. IMF added its new forecast is subject to revision depending on the length of the pandemic and lockdowns, voluntary social distancing, and displaced workers' ability to find jobs. The forecast could be upgraded if there is a medical breakthrough or business activity resumes more quickly, but significant downside risks include outbreaks requiring more lockdowns or tight financial conditions. This could tip some economies into debt crisis and slow activity further. IMF also added in US, GDP is expected to contract 8% in 2020 compared with the previous 5.9% projection. The world's largest economy may grow 4.5% next year. The euro area will probably shrink 10.2% in 2020 and expand 6% in 2021. The IMF sees advanced economies shrinking the most, contracting 8% compared with the 6.1% previously. Emerging market and developing economies will see a 3% contraction compared with the 1% forecast in April. China will still manage to expand 1% supported by policy stimulus. Global trade volume in goods and services will probably tumble 11.9% this year. IMF warned that the pandemic impact may significantly increase inequality, with more than 90% of emerging market and developing economies forecast to show declines in per capita income. In the scenario, in one, there is a second virus outbreak in early 2021 with disruptions to domestic economic activity about half the size of those assumed for this year. The scenario assumes emerging markets experience greater damage than advanced economies, given more limited space to support incomes. In that case, output would be 4.9% below the baseline for 2021 and would remain below the baseline in 2022. In the second scenario, with a faster than expected recovery, global output would be about 0.5% better than the baseline this year and 3% above the baseline in 2021. In Canada, the CD Howe Business Cycle Council added the Canadian economy entered a recession in the first quarter of 2020. Monthly GDP peaked in February, then fell by 7.5% in April. And according to the statistics, Canada's flash estimate released on June 30th by a further 11.6% in April. These declines wiped out all the growth in Canadian real GDP since August 2010 and represent the steepest and faster side of economic recession in last 59 years. Though there are some positive signs in economic data, 1.8% increase in employment, exports and building permits, as well as preliminary information indicating a 3% increase in real GDP. It is going to be a long road to get economic output back to where it was pre-COVID-19. Comparing this recession so far with the past Canadian recessions gives an indication of the length of that road. From peak to low, real GDP has fallen 18% in 2 months. None of the other 4 recessions even come close. There have been 5 recessions in Canada since 1961. If May is truly the beginning of Canada's economic recovery, and that's a big concern about a second wave, that would make April the recession's trough. With GDP speaking in February and hitting bottom in April, the recession lasted only 2 months, by far the shortest in the 5. Even the relatively mild recession of 1974 lasted 5 months. The striking thing about the COVID-19 recession is just how fast and how far GDP dropped. That's not necessarily a surprise. Large part of the economy was shut down by law. After all, but from peak to low, real GDP has fallen 18% in 2 months. None of the other 4 recessions even come close. In the severe recession of 1981, GDP fell a little over 5%, but it took 16 months to reach the trough. During the financial crisis of 2008 and 9, GDP fell a little over 4% in 7 months. Another way to think about the impact of a recession, the economic activity, is to ask how much cumulative output is lost from its pre-recession peak. If we assume throughout the downturn that at a minimum the economy should be operating where it was at its peak. As an example, imagine a 2 trillion US dollars in a year economy in February pre-COVID, which if we assume Canada produced the same each month works out to 167 billion a month. Now imagine the economy shrinks 10% in March and another 10% in April, which is close to what actually happened in Canada. That would mean 17 billion USD, 10% of 169 billion USD in lost economic output in March and another 15 billion USD in April. However, in April, the original 17 billion USD continues to be lost. We are assuming the economy should be operating at 167 billion. So April's shortfall totals 32 billion USD and the cumulative loss over the 2 months is 49 billion USD. That is 70 billion USD plus 32 billion USD in April. In percentage terms, those two 10% monthly losses add up to a cumulative loss of 29%. Moving from example to reality, this peak to through cumulative measures indicates that the COVID-19 recession has already been more severe at nearly 26% than the 21% loss in economic activity during the Great Recession. It also dwarfs the cumulative decline of 1974 recession. However, the loss so far is much less than in the recession of 1981 and 1990. During which the cumulative peak to through fall in real GDP were 37% and 51% respectively. Though they come to a bigger total, those declines in GDP were much more gradual, spanning 16 and 25 months respectively, giving them more time to accumulate. On the other hand, the recoveries after these recessions, which we define as the number of months from the recessions through to the first month in which real GDP gets back to its previous peak value, were much quicker than many forecasters think the COVID-19 recovery will be. If recovery does not turn out to be slow, the cumulative GDP loss from peak to recovery will have plenty of time to add up. The final tallies for cumulative GDP loss, that is peak to peak during the 1981, 1990 and 2008 recessions were 62, 61.5 and 49% respectively. If May GDP growth come in at 3%, the cumulative loss from February until the end of May will already be around 40%. Only a month or two more of this recession would push the cumulative loss past those of the earlier recessions, with some predictions indicating it will take until at last the end of 2021 for Canadian GDP to return to its pre-crisis level. Despite all this doom and gloom, we can end on a positive note. Canadian policymakers, both fiscal and monetary, have responded with unprecedented support. There are obvious barriers to how long and how large this support can be, but these numbers explain why it is necessary at today's market scenario.